This is like a little bit of the Wild West.
Fixing back taxes, back property taxes, condo fees.
Major lenders don't want to touch.
They just hear fees and higher rates.
What are the exit strategies?
Be aware of what your exit strategy is going to be.
Why would a private lender want to do this?
The lender will want their money as soon as possible.
Welcome, folks. Welcome to the Mortgage Den. Today is April the 8th. I'm Nick Da Silva, principal broker at Northwood Mortgage. With me today, Scott Robson, one of our mortgage brokers. Welcome, Scott.
Thanks for having me again.
It's always fun, Scott. Today, we're going to talk about private mortgages. I mean, there's lots of different types of lenders out there in our industry. You have the banks, the trust companies, credit unions. What is a private lender, Scott?
So a private lender is somebody that isn't governed by OSFI.
So that's the Office of Superintendent of Financial Institutions. So this is like a little bit of Wild West. They don't have anyone to regulate them, so they make their own rules up.
Correct. A lot of private lenders, some private lenders lend based on loan to value, some lend based on equity. A lot of them make their own decisions at the end of the day.
What is the purpose of a private lender? Why do us brokers use private lenders?
So the private lenders are great for us because if the banks say no, we have another option for a different avenue to go down. And the benefit from there is the fact that the private lenders, as you mentioned, are part of the Wild Wild West, and they make their own decisions.
So what are we fixing when we use private lenders?
So when we're using private lenders, we're fixing credit issues, we're fixing back taxes, back property taxes, condo fees, etc.
Do private lenders do anything other than that? What if someone doesn't have the income to qualify? Will they help them out?
So the benefit with a private lender is because they're not governed by OSFI, they're able to think outside the box. So which means they don't have a GDS, TDS requirement.
What are the terms that are offered by private lenders usually?
So most private lenders do a 1-year term. Some private lenders may extend past that, but the majority of them are usually just a 1-year term to fix a problem.
And will they offer renewals at maturity time?
So that's the big part, is private lenders are given the choice as to whether to renew or not to renew based on how the client was during the term of the mortgage.
Could they customize, again, a mortgage for different length of time? If they want a 9-month term or a 15-month term, is that something that's in their arsenal of products?
So once again, that's another big benefit of a private lender. They set their rules. So if they need a 6-month term, say the client's selling the property in 6 months and all they need is an open 6-month term, they can do it. Say the client's selling the property in 15 months, they can set up a 15-month term. The private lender makes the final decision.
Now, Scott, we started to talk about the benefits of a private mortgage or a private lender helping us out. You've just mentioned a few. What other benefits are there to a private mortgage?
So the benefits of the private mortgage is, say, for example, you're in consumer proposal and the lender doesn't want to lend on it. You can use a private lender in order to pay off the consumer proposal to get the person back into an institutional lender quicker.
That's the type of debt that or a situation that the major lenders don't want to touch. What other situations like that do the major lenders not want to touch?
So major lenders don't like back property taxes. They don't like back condo fees. They don't like you owing CRA. They also don't like their mortgage being in arrears. So say the client's in power of sale, you can use a private lender to bring the client back into good standing so they don't end up losing their home.
What are some of the disadvantages of using a private lender? What are the cons of using a private lender?
Cons for using a private lender is the biggest one is fees. That's the first part. The second part that comes into play is also the interest rate. So a lot of clients, when they see private lenders, they just hear fees and higher rates. But at the end of the day, if your situation warrants that, then you might need that in order to get you back into a financial institution.
What other disadvantages do you see with a private lender?
Another big disadvantage is the private lender is at their own accord to say, I don't want to renew the mortgage. So if they don't want to renew the mortgage, the client's then stuck to try and find another lender. The next hiccup is the private lender also charges renewal fees,
which are higher usually than the average major institutional lender out there.
The renewal fees are always higher than a regular institution.
So a lender charges both a rate of interest and fees. How does that work?
So the lender can charge a rate or fee based on what they see fit, based on a loan to value, based on the risk. The risk is the big thing for the private lender because the private lender is lending out their money. They're not lending out a bank's money unless it's a MIC, for example. So a MIC will pool a bunch of funds to create the money available to lend it out.
Again, we've gone to private lender. He's trying to help me out. How does he make the payments a little bit more affordable to myself if the rate is high and I can't seem to afford the payments?
So that's another big benefit from dealing with a private lender. So if you can't actually afford the payment, for example, the private lender can prepay the mortgage for the term, so long as there's the equity available to do it.
All right. Do they amortize the mortgage, or do they just charge interest only?
So because the private lender, once again, is at their own discretion, they can choose either to do interest only or amortize the mortgage. But 9 times out of 10, they're just going to do interest only mortgages in order to make it low enough for the client to afford it.
Now, Scott, what you're telling me basically is that, I mean, it's an expensive proposition to use a private lender. So no one really wants to be in this situation long term. What are the exit strategies a consumer should be looking towards when they're getting into a private mortgage?
So when you're getting into a private mortgage, make sure you have your exit strategy set out from the beginning. So whether you have to sell your property, for example, whether you have to clear up a bunch of debt, or whether you have to renew with that private lender, be aware of what your exit strategy is going to be.
You mentioned selling the property. What about refinancing?
So say, for example, you've been with a private lender for a year, you've cleaned up all your credit. Now we can look into refinancing to take you out to an institutional lender.
All right. And if the lender does, and if you can't move to an institutional lender and the private lender does not want to refinance or renew the mortgage at maturity, what's your option?
The option at that point is you probably have to sell the property.
With regards to mortgage impairment, which means people unfortunately having to miss payments, private lenders tend to be generous, or are they very aggressive in collecting their funds?
That's the biggest part about private lending, is because the private lender is selecting their own terms. If you miss a payment, if your insurance falls in arrears, if your first mortgage falls in arrears, and the lender has to bring you into good standing, the lender will want their money as soon as possible.
What you're basically saying is they're taking more risk, and because they're taking more risk, they have very little leniency with respect to missed payments or any kind of impairment to the mortgage, which means, again, things like missing taxes and condo fees.
And that's where the problem could come into play, because if you end up falling in arrears with these and you can't be taken out to another lender, the private lender can actually move you into power of sale.
So, Scott, we were talking about the different types of private lenders, and you mentioned individuals who lend their money out. Where do they get their money from to do this?
So the private lenders can get their money from their own investments. They can get it from RSPs, and some even take it from their line of credit.
Can they use their TFSAs as well?
Yes, the private lenders can use their TFSAs to fund a mortgage.
Why would a private lender want to do this?
The biggest reason a private lender would want to lend out their own money is a security. Because with the property, when they're lending the money, it's all based on the loan to value. Whereas in the stock market can fluctuate up and down, but so long as the loan to value and there's security in the property, the private lender is willing to lend the money. So Nick, Northwood started something years ago that they're very proud of. So why did Northwood get into the MIC?
So Northwood set up a mortgage investment corporation for 2 reasons. Number one, we had a lot of investors who kept coming to us with their own private funds, but they didn't have enough money to lend out on their own. Grouped together, we had enough money to lend out to people who were looking for mortgages. So that was the first reason we created a mortgage investment corporation. The second part was, when this was set up, private money was erratic, to say the least. It's hard to find investors who want to do this kind of stuff. So we needed to pool the money together to support our mortgage agents who were looking for private mortgages, who would take higher risk to help their clients out.
So I remember when I started, you said exactly that. It was very difficult to find a consistent source of income. So over the years, have you noticed that there's been more private lenders in the market or less?
Well, since we started, there's been an upsurge in mortgage brokers creating these mortgage investment corporations, right, or these type of entities to lend money out. And the market has grown over time as big banks and the trust companies and the credit unions have tightened up their lending criteria. It's created an opportunity for private investors to lend money out, have it properly secured, as you've mentioned, and make a good return on their funds.
And because of that, is every private lender created equally?
Not every private lender is created equally. As you've said, they all have different levels of risk tolerance. Some like to be in the first position. Some like to be, they'll go into a second mortgage position. The rates they charge are different. It is, as we call it, the wild, wild west. There is no menu of rates that we can point to that says this is what a 1-year term is going to be. So when we look to the market, we look to investors who are willing to take the risk, willing to accept the deal as presented, with the hope that we'll be able to fix the problem and move that lender either to an institutional lender, as you've pointed out, or if they have to sell, give them the time to sell their property on their own. Scott, thanks for being here today. Appreciate it. Hopefully, we'll see you soon on the next Mortgage Den episode.
Sounds good, brother.